Good evening, everybody, and welcome to tonight's DE Solutions Lab. I'm Pam Maragliano, Chief Editor for Dental Economics Magazine, and tonight's topic could not be more timely. I don't know about you guys, but we're honing in on the end of the year, and I don't know about you, but I'm always looking for ways to save on taxes or strategize when I get mad the year before for the year forward. So tonight's topic is 4 high-impact tax strategies to supercharge your practice's growth. We have tonight such a treat. We've got Rachel Richards. She's a CPA, and she is going to be able to tell us all the things that we need to know. Few housekeeping items before we get started. The purpose of DE Solutions Lab is to get your questions answered. So don't be shy. Please throw some questions in the chat as they come up. Or if you're a little shy and you still have questions, throw them in the Q&A. We will definitely get to them tonight. I think it's the most important thing that you leave with practical, roll up your sleeve type strategies that you can implement right into your practice. If you have any questions along the way or any trouble, again, put it in the chat and I'll be moderating it the entire time. Rachel, before you get started, I think I'm going to throw the first poll question up if that's all right.
Yeah,
All right,
of course.
perfect. All right, so we have poll questions. We've got a lot of interaction today, so get ready. This is going to be a really fun evening. Rachel, floor's yours.
Nice. Thank you. So I'm really excited to be here. And today we're going to dive deep into what you can do to really supercharge your growth for your dental practice. So we really want to, at Gelt, we really want to encourage you to think about taxes not only as something that you're going to do once a year, but something that you're really planning for year round. And there are things that you can do with your entity structure, how you're paying yourself, and every aspect of your business that you're probably already doing. Where if you think about that thing from a tax lens, there might be a way that you can be doing it better. So I want to challenge you to think about how you're structured, what you're doing, and then walk away from this with ideas on how you can evaluate your tax situation, and find ways that you can optimize your taxes in real life. And with that, we'll get into why this matters. So it's really common that we hear from physicians that, I feel like I'm doing everything right, but at the end of the year, I'm still getting hit with this big tax bill. Everyone always feels, no one really comes to us and says, I don't think I'm paying enough taxes. Um, so we really want to unlock what things that you can do around your entity, how you pay yourself, how you use your retirement plans to free up tens of thousands of dollars every year. And with that, you could reinvest in technology, staff, or even into your own wealth and flexibility. And just to give an overview of what we'll be going over today, we'll focus on your entity structure optimization, how you're paying yourself, what business expenses you're taking, retirement contributions, and then succession planning to meet your long-term goals. And this is a common thing that we'll go through with all of our clients. It's really important when you're joining Gelt that we really understand your tax situation, to find opportunities in the things that you're already doing, that could potentially be better. And so the way that we'll go through this is with a case study. So we're going to have Brightside Dental Partners. It's an example practice, based on real information, and we'll assess their situation and identify some things that we would do for them as a new client, and how we can make their tax situation better. So we have a partnership with two partners, Dr. Lee and Dr. Martinez. Overall, they have about $840,000 in profit before owner compensation, and their entity is an LLC taxed as a partnership. So first, we want to look at, oh, I lost a slide. So the first thing that we want to look at is their entity structure. So we'll stay here for a minute. And right now we have an LLC that's taxed as a partnership. And as a partnership, We have some benefits. There's a lot of flexibility about how the partnership can be taxed. You can have different allocations of profit and capital and losses. So you have a lot of flexibility there. Partnerships are really um, common ownership structures that we see up front. But you also run into you're paying self-employment tax on all of your income. And just to give a little background on self-employment tax and what that means, whenever you have a business and you're making money, you're always going to pay income tax. But how that income is taxed depends on how your entity is treated for tax purposes. So, for example, if your business is a partnership, as a partner in a partnership, all of your income is going to be subject to income tax and self-employment tax, which is self-employment tax is Social Security and Medicare tax. So, 100% of the income that's coming through to you is getting taxed in three different ways. If, for example, you're taxed as an S corporation, then you're still paying income tax on all of that income, but you're only paying self-employment tax on the amount that you're paying yourself. So if we go and we look a little bit into the next slide where we talk about compensation, you'll see that as a partnership that we have $300,000 of guaranteed payments, 120,000 of profit allocations. Then for each partner, we have total compensation of 420,000. That's going to get us to that $800,000 of profit. And as a partnership, you're paying income tax on all of this income, and then you're also paying FICA on all of Social Security and Medicare on all of this income. If you're, say, an S corporation, then you would pay income tax on everything, but you'd only pay Social Security and Medicare on the amount that you're paying yourself as compensation. So that's something really important and where S corps are often a really big savings lever for our clients. And I just want to pause there and see if there are any questions about just the difference between partnerships and S corps in general.
Rachel, there's a couple of questions that have come in. One is, what is a reasonable salary for an S Corp owner?
Yeah, so that's a great question and a question that we get a lot. So, reasonable salary is subjective. So there's no, hard and fast IRS definition on what a reasonable salary would be. Um, but it's something that you should be able to justify. Like you need to be able to justify what you're paying yourself. And you can use a couple different ways to do that. The first way and the way that's most easily documented with the IRS is to look at what you would be paid, what the market rate would be for what you're paying yourself. So if you were to go work in a practice for someone else, what would your compensation level be? And use that comparative salary as a reasonable salary. And then I think if you can read between the lines here, the lower your salary is, the higher your tax advantage would be. So as a practice owner, it's often in your best interest to try to find a reasonable salary that's going to be as low as possible. And so if you're looking for ways to have a reasonable salary that's maybe a little less than what your comparative compensation would be, there are factors that you can consider and use to justify a lower salary. For example, how much money do you actually take out of the business? If you're leaving your profits in the business, you're reinvesting, you're building, you're saving capital to build out a new office, you're reinvesting in your business. If you're keeping the funds in the company to fuel growth, that's absolutely a reason to justify why you paid yourself less. If your business isn't profitable, that's another reason where you might pay yourself less than what you would pay somewhere else. Obviously, that's not something that anyone wants to happen, but if you do have years where you don't have as much profit or you have a lot of expenses, having a salary that's too high could actually end up being an audit risk. Um, So you want to consider what your business is making, what you're actually taking out of the business, and what your plans for the business are. Maybe right now, you do want to you're planning a really big capital investment in the next few years. And so you are going to lower your salary in anticipation of that. So really just thinking about what's actually happening in your business and using that information to document and justify that reasonable salary is the best way to find what your reasonable salary is. It's really personal to your business, and that's something that at Gelt will help our customers understand what their options are, and work with you to find what that reasonable salary can be and what that'll mean for your taxes.
Thank you, Rachel. There's a question that came in about meals being deductible. Are you going to hit on that topic later
Yeah,
on?
yeah,
Okay, so
we'll
I'll
talk
hold
about
that
that
question.
in a little bit. So just to close up on the entity structure, so we have as a S corporation, you're saving that self-employment tax by having that lower reasonable salary. But what we did in this case, and what a common choice that we go with for partnerships that have multiple owners, is we actually took a hybrid approach. So we were thinking about what the partnership, what they might want for their future plans. They might want to bring in other owners at some point, and so we wanted to isolate the partnership income to really just be the pure partnership business. And then we had the partners each open their own S corp, and the S corps became owners of the partnership. So we ended up with a hybrid structure where we had the partnership owned by two S corps. The partnership would pay guaranteed payments to those S corps, and then the S corps would pay reasonable compensation to the two owners. So instead of being paid by the partnership itself, our owners ultimately ended up being paid by their own S corporations. And that unlocked a couple things. Number one, we were able to keep the P&L for the partnership really clean. And then number two, because each owner is in their own situation, when we go into talking about deductions, we'll see that, if you have different home offices or different children situations, there might be opportunities for deductions that aren't necessarily equitable to your partnership allocation. So even though these partners are 50-50 partners, um, they both want to deduct their cars, but one of the partners wants a much more expensive car. So by having their own S corps, they're able to keep the partnership really fair, and then maximize the deductions through their personal companies. Um, any questions before we move on to reasonable compensation? I know we've started to touch on it a little bit, but I just want to pause before moving on.
I think we're good.
Awesome. Okay, so I know we've started to talk about reasonable compensation a little bit, but I just want to highlight again in that partnership model, we have the guaranteed payment and profit allocation. So as a partnership, you can't pay yourself a salary because essentially all of your compensation is taxed as salary because it's all subject to that Social Security and Medicare tax. But as an S corporation, we were able to isolate and give them a lower reasonable compensation. And then the remainder was allocated through profit distributions and whatever, you're paying 100%, you're paying tax on 100% of the income, regardless of what you're taking out as distributions. So we try to have a good mix of compensation and distributions. It, um, there's no like 100% number that you would have here, but uh, a place that we try to aim to be is about 50% profit and or 50% distributions and 50% salary for everything that you're taking out of the company. So also when you're thinking about reasonable compensation, that's something that you might want to look at as well. So if you're taking $500,000 out every year and your compensation is $100,000, that might be an indicator that your compensation might be a little low. So those are just some things when we're thinking about compensation that we want to pay attention to. And one more point, we will talk about retirement as we get in deeper. But retirement can also be a factor in what you want to pay yourself. Um, in this situation, we did want to maximize retirement contributions. So we kept the salary high. We kept it at 250. We had 200 and see 250,000 per owner, so that they could maximize their retirement contributions and transition to a plan with heavier deductions. If you don't care if maximizing retirement contributions isn't a priority, then that would be a good reason to maybe staying around the Social Security limit, so around $180,000. Those are all factors that you want to consider when you're thinking about paying yourself. So all that to say, it can be complicated, and I do highly recommend working with your tax professional to understand what the implications are of the different levels of salary that you're thinking about paying yourself, so you can make an educated decision. Oh, there's my entity structure slide. But I think we've covered all of this. Um, okay. Yeah, so before we had the $300,000 guaranteed payment and 120,000 profit for each owner. And then after, when we transitioned to the two S corporations that own the partnership, we ended up with 250,000 of W-2 wages for each owner from their S corporation. So distributions and profit allocations covered the remaining income, and this gave them maximum space for their retirement contributions, which, if we look back at the beginning, they're contributing about $15,000 each with a simple IRA. And we'll touch on that, I think, in two more topics. Okay. So next we'll get into overlooked deductions. And some of the common gaps in dental practices, it's really, knowing what can be deductible. So they're the obvious things, equipment, um, continuing education. Those are things that hopefully you're automatically deducting from the business. But then there are the mixed use expenses. So your cell phone, your internet, do you do any administrative work exclusively from home? Do you use your vehicle for work? Do you visit patients? Are you going on trips for continuing education? All of those mixed use expenses are things that often they get overlooked, and they can really add up over time. And I think we have another poll.
Yes. How confident are you that your current tax strategy is optimized for you as an owner? And it looks like we have a mix.
Nice. So when you're thinking about deductions, one thing I always like to tell clients is you are your business, and anything that you need to spend that will make you do your business better is potentially a deduction. So if you're using your phone, your internet, your vehicle, all of those things, especially like your Amazon purchases, if you really like to have plants around, and so you have plans, like those can be deductible. The fact that you get enjoyment from something doesn't disqualify it from being a deduction. So for the small things, really just try to think outside the box on what things that you can do. Um, that can potentially be deductible business expenses. In my experience, I found that dentists are often the most creative at finding business deductions. I had a client once that every quarter, he would take all his employees on a shopping spree. He would rent a limo and they would go to the mall and he would give them all like $50 to go buy something or, get their nails done. And everyone would come back and share what they did. And he felt like that was something that really boosted his employee morale. And that was a business expense for him. That was employee benefits. So, really thinking outside the box on things that you can do that can benefit your business, that can also be deductions. Um, when you have those mixed use expenses, so again, with your cell phone or vehicle, things like that, those are all things that you do want to have documented in an accountable plan. So if you're having those things that are happening on your personal account, it's totally allowed and acceptable for your business to reimburse you for those expenses, for you to get a tax benefit from those expenses, but you do want to document that that's an agreement that you have with your business to ensure that you're not taxed on that reimbursement. So you do want to have an accountable plan in place. It sounds complicated, but it's just a document. It's a simple document that you can sign and keep on your computer. Keep saved somewhere so that it's handy if you ever need it. Just to confirm that you're agreeing with your business that, employees are eligible to be reimbursed for the following expenses. You want to make sure that you're submitting to your business a record of the expenses, documenting that in your books, and then that would be the route to getting the deduction. One thing that I will call out is that if something's not happening on your business account, if you've paid for something on your personal account, then it's really important to make sure that that gets recorded in your books. Otherwise, it can easily be lost. I do recommend, and sometimes this can be taken too far, but I do recommend for those mixed use expenses, maybe consider putting those in your business account, and part of that can actually be disallowed um, through your business books. But you do run the risk if you do that in excess, that could be a problem in the other direction. So just make sure whether you're running it through your business account or paying it personally, make sure that it's documented. And if you do pay anything personally, that it's recorded in your books to make sure that you get that deduction. I also want to talk about business mileage and auto expenses. So if you are using a vehicle for business, then for the percentage that you're using that vehicle, you could be eligible for a deduction. Oftentimes people will take the business mileage, which is like 58 cents per mile for business miles. It's extremely low. But alternatively, if you use the vehicle at least 50% for business, maybe you have multiple businesses or multiple vehicles, and one of them is dedicated primarily for business purposes. If you have a primarily business vehicle, then you can take actual expenses, and that would mean that part of your insurance, your gas, repairs, car washes, registration, even if you have a loan, the vehicle interest, all of that could potentially be a business deduction to the extent of the business use. So especially with heavy vehicles, this can be a way at year end to maybe get a really big deduction by getting a new heavy vehicle. And if you finance it, you could be in a position where you could potentially, put $10,000 down, but get a $50,000 deduction if you buy it in the right way. I also want to call out equipment and technology. With the new tax laws that came through this year, we are able to take 100% bonus depreciation again. So if you are considering a build out, not only do you want to like think about all of the costs that you have there, but you really want to look at what you're spending that money on. Anything that could be considered a leasehold improvement, so something that's not structural, and you could potentially remove. That would be eligible for bonus depreciation. So if you're doing a build out, you don't want to just say, this is everything that I spent. You really want to look at that breakdown of what you actually spent money on, because there could be tax advantages by breaking that down into further details. And then one more thing that is also common for dental practices, if if you have any lab work that you're doing in-house, that could potentially be eligible for R&D tax credits. So often when you are thinking about dentistry, you're not thinking, I'm doing research and development. But that is something that does qualify for the research and development credit. And so that could be an opportunity to look into as well. Any other questions on deductions? I know you mentioned one about meals.
Yes, there's a few questions that came in regarding deductions. Are meals deductible in 2026? I usually give free lunch for my team when we meet our production goals.
So meals are a little bit tricky. They are not 100% deductible. So 50% of your meals are deductible. And in the past, if you did have employee meals, so you were, hosting a meal for all of your employees, there was an exception where that could be considered 100% deductible. But that's also phasing out. So for 2026, all of your meals will be considered 50% deductible.
Excellent. Are profit allocations, distributions taxable?
Yeah, well, it depends. But for partnerships and S corporations and disregarded entities, yes. The exception would be if you have a C corporation, your profits are taxed. Well, and then also your distributions are taxed when they're paid out to you. But so I guess in all cases, yes, your profits are always taxed. And then your distributions is from S corps or partnerships, because you've paid tax on 100% of the profits when you earned it, you don't pay tax on the distributions. So that's the difference between the partnership and S corp, those pass-through entities, and the C corporation, which is subject to double taxation.
Thank you. What about uniforms? Are uniforms deductible? We bought the team uniforms for our team in 2025.
Yeah, so uniforms are deductible as long as they are not something, they either need to be not something that you would wear in ordinary situations. So if they're scrubs, that would be deductible. And if they're not scrubs, then they would need to have a logo on them if they're some kind of ordinary clothing in order to be considered deductible. And if your uniforms are deductible, then cleaning those uniforms is also deductible. So that's an addition to uniforms that's often overlooked.
Fantastic. Can you review one more time the commuting expense from residence to the practice?
Yeah, so commuting from residence to the practice wouldn't be considered business mileage. But if you were commuting to, say, continuing education, or if you did some sort of client, like if you did any kind of patient visits, or commuting to pick up supplies, all of those things would be considered business mileage. But going to and from your primary place of business would not be considered a business mile.
Excellent. Thank you.
You're welcome. And one more thing I wanted to touch on around the uniform. You had the question, we had uniforms. Um, there was something.
We had meals, salary, profit allocations, distributions, uniforms, and then commuting.
mm, I'll if it comes back to me, um, I'll bring it up. Okay. So next we'll go into retirement and succession planning. So with retirement plans, I've listed three options here, but you have more than three options. There are lots of options for retirement plans. Um, but just to give a high level overview, we start out with individual plans, which would be a traditional IRA, a Roth IRA. You can contribute about $7,000 a year to those plans. Um, and that's kind of the entry level retirement contribution. Then, if you have a business, you have a simple or a SEP IRA. A simple IRA is simple. You can contribute about 3% of your compensation as a match, and then up to about 15,000 as an employee contribution. For a SEP IRA, you only have an employer contribution. And I think actually to preface this a little bit, we're thinking about retirement plans, we have employee contributions, which is what you would contribute as an employee and will be deductible on your personal tax return. And then we have employer contributions, which your business will contribute to the plan and will be deductible on the business profit and loss statement. Ultimately, everything will float through to your personal income tax return. But when I'm saying employee contributions and employer contributions, that's the distinction that I'm making there. So with the SEP IRA, you only have employer contributions. And for partnerships, it's going to be based on the profit of the partnership. And for S corporations, it's going to be based on the compensation that you're paying yourself. So the SEP contribution is really based on the amount that's subject to that payroll tax. And you can contribute up to 20% of that compensation, and then it caps out around $70,000. So the SEP IRA, that's where you would need to have quite a high profit or salary in order to max that out. And so, usually, if you're wanting to maximize your retirement plan, we would recommend 401k if you want to contribute that 60, $70,000 range. The reason that I would recommend a 401k over a SEP is that you have a lower salary threshold that you need to meet in order to maximize those contributions because you get to defer you get about $23,000 of employee contributions, and then the remainder up to that same $70,000 limit can be contributed as an employer contribution. So by breaking it up between employee and employer, the compensation that you need to give yourself goes down for that 401k. You also can have something called an employer match, or sometimes it's referred to as a safe harbor employer match, or a profit sharing plan. So what that is that's additional money that your employer is contributing on top of the amount that you've put into your plan as an employee. Some things you want to think about if you have a 401k and you want to make those employer contributions is if you have other employees, making a really large contribution becomes more challenging, because you can't just say, I want to put in, you know, 25% for myself and 5% for the rest of my employees. You have to be equitable across all of your employees. So if you're putting in 25% of your compensation for yourself, you would be required to put in 25% for all of your employees. So that's one of the things that you want to think about with a 401k. Oftentimes, if there's only one owner, we call it a solo 401k, and that'll be kind of the easiest way, if it's possible, where you can maximize the retirement benefits that are going directly to yourself. And then once you start to have more employees, reaching that $70,000 can become more complicated. And then if you want to contribute even more, you're doing really well. The highest level of retirement contributions is going to be a defined benefit plan. And one of those that we talk about the most is called a cash balance plan. Um, so what we have is the SEP IRA and the 401k, all of those plans are considered defined contribution plans because you're saying every year I'm going to contribute 20,000, 30,000, 40,000, and then that money is going to grow, and at retirement I'm going to take it out and it'll be taxed at whatever tax rate I'm at in retirement. So I got a benefit now and then I'll be taxed later. With a defined benefit plan, instead, you're going to say, okay, I want to have 80% of my compensation paid to me in retirement. And so an actuary will do a lot of complex calculations and say, okay, in order for you to have 80% for all you and all of your employees to have 80% of their compensation, this is how much you need to put in the plan this year. And so instead of you saying, I'm going to put that much in and see what it grows to, you'll start with, this is how much I want to have in retirement, and back into, this is what you need to contribute now. So with those defined benefit plans, like a cash balance plan, you can contribute to $300,000 to retirement plan in 1 year. That would be deductible for your business. So it can create a huge tax savings, set you up for the future, set your employees up for the future. But caveats to a plan like that are, again, you can't just contribute to yourself. There are a lot of calculations that go into it. You will end up contributing for your employees, their age, how long they've been with you. All of those things will become factors in those calculations. And then you do need to commit to making that contribution for quite a few years. So usually at least 3 years, you would want to commit to making that $300,000 contribution in order to really have that cash balance plan. So it is a big commitment. It comes with higher administrative costs, but at the end of the day, you can make six-figure contributions instead of five-figure contributions. So it can present a huge tax advantage if you're doing really well. Any questions on retirement planning?
There are a few questions, and if it's okay, I'm going to launch another poll question while we go
Yeah.
through them. Perfect. So go ahead and answer the poll question. Which area are you most interested in improving as a result of this webinar? Um, and there's a few answers there for you. So, would you be able to recommend a reputable 401k service provider or a few that you've worked with that you've appreciated? This individual is trying to set up a safe harbor 401k retirement plan next year to avoid discriminatory audits.
Um, so I would recommend if you're working with a financial planner, they would usually be able to recommend a plan administrator. We do have some that we've worked with, but the plan administrator is usually very closely connected to the financial planner. And so if you're looking at opening a retirement plan, I would highly recommend, having those two work in unison together. Um, and if you're thinking of opening, if you want something, the Safe Harbor 401k, something that is relatively straightforward, you might be able to go to like Fidelity or Schwab or create a plan that can be compliant, but could have a low administrative cost and be more self-service. If your plan assets are under $250,000, your compliance requirements, especially for those safe harbor plans, can be quite low. So you might not be required to file certain forms. Again, it's really personal to your situation. So it would be hard to say generally, you should do this or that.
Awesome. There was another question about providing 401k benefits to all employees. Is there a differentiator whether the employee is a full-time versus a part-timer?
Yeah, so part-time employees are treated differently for actuarial purposes. They're generally not considered for your retirement plan contributions. And if you do have a plan with employees, you can expect to complete, they'll call it a census each year. So you'll provide the W-2s and then fill out a little form of like how many hours each employee worked, and so they'll use that information to do their calculations and see who needs to be included in the plan, who is exempt. And then they'll usually come back to you with this is the amount that you would need to pay. Or sometimes you can get some options, like if you want to do 5%, this is what it would look like, this is what it would look like in different scenarios. So you can decide after the fact what you were going to pay. Something to note for retirement plans is the employee contributions. Those happen during the year. So as you're earning the money, the employee is putting that contribution away. That's reported on their W-2. But the employer contribution is something that's generally calculated. It can be done contemporaneously throughout the year, but oftentimes it's fully calculated at the end of the year. And so another benefit of retirement plans ends up being that you can save the cash flow. So you might not need to make that retirement contribution for 2025, say until August or September of 2026. The downside is the money's not in the plan, so you might miss out on earnings. But the flip side of that is if you have liquidity issues or you had a really good opportunity, there is more flexibility on the employer side in terms of cash flow with those contributions.
Excellent. I have one more question, and if you want me to hold it till the end, I can. This one came in when we were talking about deductions. This one is, can I deduct the full cost of purchasing a dental practice in the year I purchased it?
It depends, but most likely no. So when you're purchasing a dental practice, do you want to think about what are you purchasing? That's something that's generally outlined in your purchase agreement. And in most cases, that would be split between your purchasing assets. You might be purchasing patient lists, vendor contracts, inventory, etc. All of those things are taxed differently. So if you're purchasing assets, that's what's most likely able to be written off in the first year, depending on what it is. So if it's a bunch of equipment, that would be really good for a potential immediate write-off. If you have a lot of goodwill, so that's the difference between all of the things that you isolated, that you're paying for and the total purchase price. That's something that you're going to be deducting over most likely 15 years. So it really depends on the breakdown of that purchase price, how you're going to get a benefit. And that's actually a good segue into succession planning. Because on the same aspect, if you're thinking about selling your practice, what you're selling is going to be really important for how you're going to ultimately end up being taxed. And the time that you want to start thinking about that is when you're opening the business, when you're choosing that entity structure. Because, for example, if in the beginning we had decided to transition our business from a partnership to just an S corporation, and the entity that you wanted to sell your business to was another business, that could potentially be really painful and could affect maybe your purchase price or your ability to go through with the deal. Because an S corp can't be owned by another business, it has to be owned by an individual or a revocable living trust. So by being an S corp and having, if you're receiving insurance proceeds, your EIN number is really important. So having that entity structure is something that you want to always be thinking about, from the beginning. Like, what do you see happening if things go really well? What would it look like if things went really poorly? What ultimately do you see as your succession planning? Do you think that you would want to sell your business to someone else? Um, would the business, would it continue on to other family members? And those decisions and those plans could impact what you decide from the start. But regardless, when you are thinking about selling, definitely what you're selling is going to be just as important as when you're buying a practice, what you're buying. So in the buyer and seller will have opposite interests. So what's going to be as the buyer, we talked about how goodwill, the difference between all the things we identified and that total price, that was treated poorly for tax purposes. We have to take that over 15 years. For the seller, that goodwill can be really advantageous for tax purposes. That could be that's subject to capital gains tax rates instead of ordinary tax rates. So, as a buyer and seller, you do have competing interests when you're agreeing, you've agreed on a price, but more than the price, what you're paying for is going to make a huge difference in ultimately how much tax you're going to pay. So that's definitely a time where you want to work with a lawyer and a tax professional to make sure that the deal is working to your best advantage.
Excellent. Thank you.
Yeah. And yeah, some key takeaways here. I just want to emphasize that there's no one size fits all strategy. Your strategy is completely personal to you. So the things that are going to, taxes are my life, but taxes shouldn't be your life. So when you're thinking about taxes, we want to choose strategies and we want to find opportunities that are going to work with the things that you're interested, the things that you're already doing, and the things that you want to do. If we say, hey, you can get a really great tax advantage by owning rental properties and renting them out as short-term rentals, that might be true and you might get a lot of tax savings from it. But if you don't want to be a landlord and you don't want to, manage tenants and have an Airbnb, then that's probably not something that's ultimately going to work for you because the benefit is great, but it should be able to fit into your life. And there are so many things, whether it's charitable giving or retirement savings or tax advantage investments. There are tons of things that can have tax advantages. So what we like to do at Gelt is really focus on what's important to you and find the ways that we can make the things that are important to you work for you. So everything that we've gone over today is, just an example of what's worked in one tax situation for two people. So there's no one size fits all strategy. The things that worked in this case might not be the best things for you. And there are thousands of opportunities out there. We've really just scratched the surface here. Your entity structure and types of income really matter. And small moves can turn into big tax savings. So really, when you're thinking about your tax strategy, you want to look at the big picture and focus on the ways where you can make the biggest impact with ultimately the least amount of effort for you because we're in taxes, but you're not. So I just want to really highlight that as we close this out and also talk about how to reach us. So I have on the screen our link to a dedicated site where you can reach out to schedule a call. And I believe we have a special for where you can get 10% off the first year of service if you mention dental economics when you sign up to schedule a call.
That's amazing. Would you be able to put that link in the chat by chance?
I sure can.
That's incredible. I'm going to put the last poll question up. We have a few more questions to finish up the evening. So everybody, please open your polls and answer the final polls. And thank you. I'm going to copy this link and I will share this with everybody. Perfect. Not this.
Oh, I think Max has shared it.
Yes. Here we go. There we go. I just re-added it to the chat. Okay, let's couple last questions. I heard that state income taxes can be paid by the S corp instead of the S corp owner under the one big beautiful bill. Is this correct?
Yeah, so not quite under the one big beautiful bill, but with the Tax Cuts and Jobs Act, they instated we used to be able to deduct 100% of state income taxes as an itemized deduction on your personal tax return, and with the Tax Cuts and Jobs Act, they reduced that to $10,000. Which if you own a home and have over $10,000 in real estate taxes, that means that none of your state income taxes would be deductible for tax purposes. With the One Big Beautiful Bill, they have set in some rules to increase that limit from $10,000 to potentially $40,000, depending on your tax situation. But the workaround that you're describing is called the pass-through entity tax. So if you're doing business in a state that has income tax and they do allow something called a pass-through entity tax election, which not all states do, but most do, then what you can do is you essentially pay the tax at the business level. So you get a federal income tax deduction. It reduces your federal income tax. Your state income tax is unchanged because your state income taxes aren't deductible for state income tax. And so you reduce your federal income tax, and then on your personal state income tax return, you get a credit for the tax that your business paid on your behalf. So essentially, you're taking something that wouldn't have been deductible and turning that into a business deduction for federal tax purposes. So this is a really cool opportunity, depending on the state that you're living in, whereby simply doing something that you would be doing anyway, you're still going to need to pay those state income taxes no matter what. So by just paying them in a different way, you can unlock a huge tax advantage. And that's a great example of something that just doing something that you're already doing, but looking at that and coming at it from a tax perspective, you can do the same thing but get a much better outcome. So that's a great one.
That's really good advice. One other question here. Can part-time employees participate in a simple plan?
So all employees can, well, depending on your plan document. So this is often something that you'll define when you're creating the plan. But in most cases, part-time employees may be eligible to contribute to the plan. But whether or not you're required to make an employer contribution, generally part-time employees are exempt from that.
Excellent. I think we are out of questions finally. Well, thank you, Rachel. I told you, everybody, that you were in for a treat tonight. That was so much information. It was absolutely incredible. And I feel like it was so great to be able to, I don't know, get us in the mood for thinking about taxes as the end of the year here. So make sure I put the link in into the chat. So if you are interested in learning a little bit more, reaching out to Rachel or her team, please feel free to do that. Thank you for so much for joining us for DE Solutions Lab. For future DE Solutions Labs, please follow us on Instagram at Dental Economics Official. If you'd like to re-watch this one, because this one has a lot of information that you're going to want to re-see, don't worry, this is going off to our video team. This will be online at www.dentaleconomics.com, and you'll see a tab that says Solutions Labs. This will show up here probably as early as next week, so keep an eye out for it. Rachel, thank you so much again for joining us and for your excellent information. And everybody out there, thank you for joining us tonight, and we will see you at the next one. Have a wonderful evening, everybody.
Thank you.
Thank you so much. Good night.